Welcome back to another episode of The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, it cannot take care of itself. Up this week is the mother of all internet search engines. Yes, that's right, Google. We're going to look at the stock of Google, Google Inc., which since going public in 2004 has been one of the great success stories on world stock exchanges, certainly that based in the US where its headquarters are located. But Google is a global company, and anyone who invested at the beginning and has it today has seen a 10-time increase in their money. So quite a run. Look at that. Up from $50 to say $554 a share today. Question we're going to type in the little box today and say is, should we keep holding Google? Is Google remain the investment that it was in 2005, 2006? Not the easiest answer, and not even an answer Google itself could come up with. Let's look at the basics. The market cap is $379 billion for the enterprise. So that means at $554 a share, the whole business is worth a lot of money. It was $190 billion in 2010. It throws off $11 billion a year, not shown here, but $11 billion in cash flow, so quite a lot of money. Now, the question is, how does it get its money, and where will it get its money in the future? The reality remains that Google's money comes from search. When you click on every little box on the internet, on your phone, whatever device you have, that's money into the pockets of Google. Google has been better at searching the internet, finding you answers, charging revenue to its customers and its suppliers and all the others that it works with. And that's how it earns its money. It's been less successful at redeploying capital into other businesses. They've been good, don't get me wrong. Android on the mobile phone space, YouTube on the internet, and GPS. Let's not forget GPS. Every car driver in the world pretty soon is going to put their mobile phone device up on the dashboard and go where they want to go. So Google wins in many areas. The question is, at 17 times earnings, at a growth rate that it's about 15% return on equity per year, will it continue that growth? Will you get to the point where the $550 stock will be $800, $900 a share? Could well be. Don't count Google out. My reservations about Google are these. They've been successful at what they've done, and they do it better than anyone else, but it doesn't mean other people can't do it. A second concern I have with Google, especially in Europe and Asia and other places, is the competition isn't just other companies, it's governments. So antitrust is a concern, as are other regulatory matters. The fact remains, you own Google, you're delighted, you're over the moon. You think, when will this stock ever stop growing? And it may not. At the same time, at $600, $650, even $700 a share, I think I'm more of a seller rather than a buyer. I admire Google. I like what they've done. I like who they are. I like what they achieve. I like the ethical positions of those running the company. But it's a little rich for my blood. 17 times earnings is not expensive. And you can say that their record justifies putting all your money into Google. At the same time, prudence says to me, they've done better in the past than they might in the future. That's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself.